Welcome to this market dive. Today we're diving into this pretty fascinating piece you sent over. It's from Alfonso Peccatiello, Alf as he's known.
Hmm.
His Macro Compass, published March 31st, 2025.
Okay.
He calls it the macro unicorn, and, well, I gotta say, the title alone piqued my interest.
Yeah.
So our mission today, let's break down what this unicorn is, what this market phenomenon is all about, and really try to understand what it could mean for, well, professionals like us trying to navigate these markets.
Yeah. And right off the bat, what really caught my eye is just how rare this situation Al's describing actually is. He's talking about the S&P 500 and the US dollar both declining at the same time.
Okay.
And, that kind of flies in the face of what we've come to expect, especially since, post-2008. We haven't really seen this kind of significant move since, well, the first half of 2008. So that's a pretty long time in market terms.
Yeah, for sure. I mean, usually the way it goes, right, is when the S&P takes a hit, investors, they kind of run for cover, right?
Hmm.
And that cover is off of the US dollar. They see it as a safe haven, pushing its value up.
Right.
But now we have this macro unicorn situation, right?
Yeah.
Both the S&P and the dollar falling together. That's the curveball. That's the thing that's really making people scratch their heads. And Alf, he points out the last time he clearly saw this happening, but for now, was back in July of 2008. Okay, so let's dig into why this inverse relationship, right? Why is it typically the norm? What's the underlying logic there?
So a lot of it boils down to how the global financial system kind of, well, I guess you could say evolved after that 2008 crisis.
Mm.
Alf puts a lot of emphasis on the growth of the Eurodollar system. You can think of it as the U.S. sort of becoming this central hub for global capital.
Right.
Countries running these trade surpluses, they end up with all these extra dollars. What do they do with them? They often park them in U.S. treasuries and, of course, U.S. stocks. So the U.S. essentially becomes the world's banker, and when trouble hits, everyone needs dollars.
So you're saying during a market downturn, there's this global rush, this scramble for dollars.
Precisely. Yeah. Alf also points to these, what he calls growth-friendly disinflationary policies and a period of, relative global stability, kind of this Pax Americana idea, which just further cemented the dollar's role as this ultimate safe haven. Okay. So when you have a risk-off event, and that could be something like a major drop in the S&P 500, well, suddenly all those entities around the world, those holding a big chunk of, get this, over $12 trillion in USD-denominated debt.
Wow.
They got to get their hands on dollars, right, to service those debts. And obviously that increased demand, it naturally pushes the dollar's price up.
It's almost like a global margin call, but in dollars.
Yeah, exactly.
Yeah.
And it doesn't stop there. Think about foreign investors. When markets get jittery, they often turn to U.S. Treasuries. Why? Because they're betting the Fed's going to step in, they're going to cut rates, try to calm things down. And this buying of Treasuries that further strengthens the dollar as capital flows into the U.S. And then you add on top of that, as Alf notes, those same international investors, they might be hesitant to dump their U.S. stocks. They're hoping, right, for that Fed intervention, the one that's going to restore confidence and boost prices.
Right.
So it's like this whole system reinforces itself. The usual outcome, a stronger dollar when the S&P falls.
Okay, so these macro unicorn episodes that Alf points to in 1998, 2002, and then the first half of 2008, these are like the exceptions that prove the rule, right?
Yeah.
They highlight how truly strange this current situation is. So what made those periods different?
The common thread, and this is what Alf identifies, they all involve the rapid kind of implosion of bubbles that were really, truly U.S. specific. If you think back to like the dot-com bubble bursting, right, around 2001, that was very much a U.S. tech phenomenon, right?
Mm.
And then even the early stages of the U.S. housing market crash in early 2008, before it became this global meltdown, that was very much focused on the U.S.
Yeah. Okay.
So you see, these weren't your typical, broad global risk-off events. The problem, the crisis, it originated right here in the U.S.
Ah, okay. So if the problem starts here in the U.S., then the dollar doesn't get that safe haven boost. It's almost like, I don't know, it's not as safe a haven anymore because the problem's coming from within the haven itself.
Exactly. That's a great way to put it. And that leads to the big question Alf raises. Are we witnessing the early stages, the beginning of yet another U.S.-centric crisis right now? And he points to a few potential catalysts that are worth considering.
Let's dive into those. What's the first one he highlights?
Well, first up is policy uncertainty.
Mm.
And a big part of that is this potential for unpredictable tariffs if, a future Trump administration were to come into power.
Mm.
Alf argues that businesses here in the U.S., they need some degree of predictability.
Right.
And when you have this constant threat of And tariffs being imposed or changed without much warning, it makes it incredibly tough for them to plan for the long term, whether it's investments or hiring. It just injects this massive dose of uncertainty into the whole economic outlook.
Absolutely. I mean, how can companies plan if they don't even know what their import costs are going to be a year from now, right?
Exactly.
What's the second potential trigger he
Uh-huh.
mentions?
Okay, so this one's pretty significant. There's a leaked White House memo making the rounds, and even Elon Musk has weighed in on it. This memo suggests a potential cut, get this, 25 to 35% reduction in the federal workforce.
Wow.
Alf points out that could translate to something like 800,000 federal employees losing their jobs. And the stated goal, to save around $1 trillion annually by the end of May. Now, the sheer scale of a cut like that could have major ripple effects throughout the entire U.S. economy.
I mean, talk about disrupting the labor market, right? It's a lot of people. Okay, so the third factor that Alf brings up is all about leading indicators for the job market, right?
Exactly. He references this really interesting work by Guy Berger, the former chief economist at LinkedIn. And Alf considers him, a really credible, unbiased analyst.
Okay.
So Berger has this diffusion index that he looks at, which focuses on future headcount plans. Basically, it tries to gauge whether companies are planning to increase or decrease their workforce in the near future. And reportedly, what this index is showing now is a weaker outlook than we saw even right before the last election. And even more concerning, the index for recent employment actions, the things that have already happened, it's actually lagging behind where it was at the same time last year. So you're seeing this softening trend in the job market even before those potential federal workforce reductions even come into play.
So instead of just looking at who's hiring now, this index is trying to anticipate who's planning to hire or fire in the coming months, right?
Precisely. It's about getting ahead of the curve, anticipating where things are headed.
So let's recap. We've got this policy uncertainty hanging over everything, the potential for, massive job losses in the public sector. And then on top of that, leading indicators suggesting a cooling private sector job market. That definitely paints a pretty, I'd say concerning picture for the U.S. economy specifically.
It does.
Now, Alf also talks about this idea of foreign investors possibly unwinding their investments in U.S. equities. How does that fit into this whole macro unicorn scenario we're discussing?
This is another really crucial piece of the puzzle. Alf highlights this unusual observation made by Brent Donnelly, a market analyst. He noticed that there was a month recently where the German DAX index actually rose while the U.S. S&P 500 fell. Now, that's not something you typically see.
Right.
They usually move more or less in the same direction. And this could be an early sign that foreign investors, they're starting to reduce their massive holdings of U.S. equities. They built up these holdings over the years, since 2010, largely because of those trade surpluses they were running, right? Countries like Germany, Norway, with their strong export sectors, they end up with all these dollars, and they end up reinvesting those dollars back into U.S. assets.
Yeah, makes sense.
But Alf emphasized the sheer size of these holdings. Think about it. Canadian and Swiss investors, just as an example, they hold U.S. securities that are worth more than 100% of their entire GDP.
Wow.
That's a huge amount of exposure to the U.S. market.
Yeah.
So he poses this really important question, right? What if these major international investors, what if they decide, you know what, we need to scale back our U.S. exposure? And there are several reasons why this might happen. You've got this perceived shift in the U.S. geopolitical stance, right? Maybe a less supportive policy environment here at home, a Fed that's not as quick to respond to economic concerns, tighter fiscal policy, the list goes on. And then there's the ongoing uncertainty for businesses that we talked about earlier. And of course, the fact that U.S. equity valuations, they're still pretty high.
So let me make sure I understand. If these big foreign investors, if they start selling off their U.S. assets, that could put downward pressure on the S&P 500. And then potentially, if they take those funds and, reinvest them back home or in other markets, that could also put downward pressure on the U.S. dollar as well.
Exactly. That's the key takeaway. And then Alf goes even further, right? He brings up this possibility of a sudden, almost like a surprise shift in market correlations.
Yeah.
And he draws this interesting parallel to early 2022. That's when we saw this long-standing negative correlation between bonds and stocks. It just flipped to positive.
Oh, right.
And it was all due to the Fed's aggressive interest rate hikes. So he's saying a similar unexpected change in how the S&P 500 and the U.S. dollar move relative to each other that could really catch a lot of people off guard. It's like when you suddenly realize your trusty umbrella's got a hole in it and it starts pouring rain.
Yeah, not the best timing.
Not at all.
Now, Alf also mentions this thing he calls the Trump administration's arduous trifecta, What is that exactly, and what kind of risks does it pose in this whole context?
So the Argios trifecta, it refers to this goal of simultaneously achieving three things, right? You want a weaker U.S. dollar, lower bond yields, and a strong stock market. And historically, Alf explains, to pull this off, you usually need very disinflationary policies, the kind that naturally push yields and the dollar down. And you also need a very supportive central bank, one that's actively trying to boost investor confidence in the stock market. But here's the thing. He argues that the current mix of factors we're seeing, with geopolitical tensions, the threat of tariffs, and this overall economic uncertainty, it might actually lead to that weaker dollar and those lower yields.
Okay.
But not in a good way. Instead of being driven by falling inflation, it could be driven by concerns about the U.S. economy itself. And that, of course, would also negatively impact stock prices.
So instead of a best case scenario, we end up with this worst case scenario where everything kind of weakens together because of these U.S. specific problems. That's a pretty sobering thought. But let's shift gears a little bit and talk about what this means for investors. Alf suggests that this potential return of the macro unicorn after more than 17 years, it has some serious implications. So what are the key takeaways here for professional investors like yourself?
Well, for those focused on long-term macro trends, Alf's suggestion is that it might be time to rethink that traditional strategy of using the U.S. dollar as a hedge against stock market declines. You see, in a macro unicorn scenario, if you're holding long positions in both the USD and stocks, that could really backfire. Both assets could potentially decline in tandem. That safety net that the dollar usually provides, it might not be there. Or even worse, it could amplify your losses.
So it's not just about missing out on potential gains, it's about potentially increasing your losses as well. That's a really critical point for anyone thinking about risk management. What about those more actively trading, hedge funds and the like? Does Alf have any insights for them?
He does. He specifically mentions that for hedge funds and other institutional investors who are very active in the market, this macro unicorn scenario could actually create some unique opportunities, especially in the derivatives market.
Yeah.
He thinks they might be able to structure some really interesting trades that are specifically designed to profit from this unusual correlation. He even suggests that he's open to brainstorming specific strategies with those who reach out to him on Bloomberg. So yeah, he's definitely thinking outside the box here.
So it sounds like today's deep dive into Alfonso Peccatiello's macro unicorn analysis has revealed a potentially very significant and, let's be honest, rare shift in how we need to think about market dynamics. We're talking about the U.S. dollar weakening alongside a falling S&P 500, and this is a pattern we haven't seen clearly for a long time, since 2008. And as Al argues, it seems to be tied to economic challenges that are, well, unique to the U.S.
Right.
We've unpacked the historical reasons for this typical inverse relationship between the dollar and U.S. equities, and then all these potential factors that might be driving this current divergence. And we've talked about, the policy uncertainty, the possibility of these substantial federal job cuts, and then this growing likelihood that foreign investors might reduce their exposure to U.S. assets.
Yeah.
Given just how rare this macro unicorn is, it's something you really need to carefully consider, especially when you're thinking about your professional investment strategies.
It really is. And it all boils down to a fundamental question, right?
Yeah.
How are you adapting your investment approach, your risk management frameworks, to prepare for this kind of environment? One where those traditional correlations might not hold true anymore, and one where a downturn originating right here in the U.S. could impact both your equity holdings and the U.S. dollar at the same time.
Yeah.
That's the million-dollar question, or maybe the trillion-dollar question, given the scale
Yeah.
of what we're talking about.
Exactly. Food for thought. Right.